What is happening, Bulls and Bears? We're back. And yes, the banks are seeing their worst nightmare come true. Banks are being forced to sell off bonds. The buyer and lender of last resort that has historically been there, the central bank, is not there like it used to be. Let's take a look at a chart here. And what are we looking at here? We're looking at the balance sheet of the central bank. It used to be always that the central bank was going to be there. We saw what happened in 2020. The central bank had to come in, buy huge amounts of debt to keep a lot of these banks propped up, actually, to keep a lot of companies propped up, businesses, the money printing. This is the total assets, though, got up close to $9 trillion. Now, we saw it come down. It went up in March. Now, some people said that there wasn't a bank bailout in March. I begged to differ at that time because all you have to do is look at the balance sheet. Let's go into a 1-year chart here. All you have to do is look at the balance sheet. Right around the time of the bank failures, they came in with massive amounts of purchasing on this bank debt. So do you think that's just a coincidence that the balance sheet zoomed up at that time, and ever since then it's been dropping? So this is what's happening, folks. The bank's worst nightmare has come true. The buyer and lender of last resort is not there. In fact, the buyer and lender of last resort here is selling assets off instead of buying. So the balance sheet is dropping. So what does this mean? This means that these banks are going to have to find buyers elsewhere. And that means they're going to have higher yields, because who's going to buy this debt at the ultra low yields that the central bank had been buying it at, right? So if you get a real investor out there that really has money on the line, money that they can't just print, then we're seeing big problems and spiking rates. In fact, let's look at the 10-year yield today. And right here we see the 10-year bond up to 4.23%, folks. That is a doozy on the 10-year. Let's go ahead and bring up a chart on this one. And we have to go pretty far back to see this rate or something near this rate. We're talking about here 2006. So we're at 17-year highs here on this rate here. Now, the good part about that is banks need your cash now more than they did before, and they're offering higher yields. In fact, if you're someone that has saved cash and you have some money to just set aside in a CD, you can get a pretty good return. Let's take a look at this return right here. And let's go right over to Investopedia. Top CDs today, 3 new high yield options with a leading rate of 5.9%. So folks, we're approaching 6% on a return on a CD. You can also get pretty close to 5% on a money market. That way your money's not locked up like it is in a CD and tied to a term of 12 or 18 months or something like that. And that's why I've always mentioned being diversified, playing both sides of the field, right? You don't want to be all in cash because of inflation, the rising costs. And, here we've always said hold some cash in case of situations like this where you're going to get a pretty good return now on your cash. And the other scenario would be buying opportunities. You see buying opportunities come up in bear markets. And if things continue, we're going to see, it looks like some deflation in some areas. Now, this can be engineered in a completely opposite direction. We've got the BRICS nations out there coming out with their announcement here in less than a week. And that's going to tell us what's going to happen with the BRIC currency. Is it going to be tied to a weight of gold? Will this devalue the dollar? And actually just the thought of it out there, even if it's not tied to a weight of gold, for example, just the thought of having a competing currency out there could be enough of a confidence breaker that some of these markets would start selling off, and you'd see some of the, even the big money investors starting to dump their portfolios. Let's talk about protecting your wealth. The US dollar has lost 85% of its purchasing power since the 1970s, when the dollar was decoupled from gold. And the government seems bent on continuing the tradition. From now until the next elections, the government can print as much money as they want. The last time they did that, inflation went up 9%. This means one thing: the security of your future and your family's future is all in your hands. Make sure you freeze the value of the wealth that you're holding. Invest in gold with Noble Gold Investments. Gold is the one asset that has proven to withstand recession, inflation, and just about all economic threats. Noble Gold Investments is here to help you if you want to invest in gold. You will also get a 24 karat 1/4 ounce gold standard coin for free. Go to bullboomgold.com now. That's bullboomgold.com, or simply call 877-646-5347. Noble Gold is the only gold company I trust. Link down in the description of this video. All right, so good news there if you're someone that's holding cash. And people sometimes accuse me of not having good news. Well, this is pretty good news for certain people. Obviously, if you don't have any money to invest, it's not very good news, because that means you have to borrow money for most things that you buy, and the rates to borrow the money, the rates are very high. So good news to some people is bad news to others. So we try to keep it balanced here on this channel because we know there's a lot of people out there with very diverse situations. Let's talk about this news article right here. This was widely reported. This happens to be out of the AP here. Small Minnesota town will be without police after the chief and all of the officers resigned because the pay was too low. And so all the police officers resigned. I dug into the article a little bit here. $22 an hour is what they were paying. So putting your life at risk for $22 an hour. I mean, there's other dangerous jobs out there. Now, just working at a retail location, you're putting your life at risk because we see what's happening with all the bad stuff going on here with retailers. But they said competing departments are paying $38 an hour. So this city obviously was on some sort of budget, or just their leaders, didn't have very good methods in place for retaining these police officers. This story doesn't get into all those types of details, what kind of budgeting they had, what their other expenditures were. What else were they spending money on? If they can't spend it on the police force, what are they spending it on? But cities are highly dependent on tax revenue. And when people are losing their jobs, when they're getting laid off, when they're not earning very much, it's basically a double-edged sword, because now they're not getting enough tax revenue to pay these officers and city workers, etc. And of course, they can't pay them as much. So then the tax revenue slips even more, because now people are quitting, and they're going to leave the city and probably go find a higher paying job, maybe in the next city, maybe in the next county, who knows? But we're going to see a lot more stories like this where cities lose all of their officers. We already saw a big outflow starting in 2020 for other reasons, but stories like this are going to become a lot more common, in my opinion. Oh, and actually, back to the bank thing real quick. This is the article I wanted to show you at the very beginning. PNC sells $750 million worth of bonds as banks rush to raise cash. From Business Insider, bond yields are flashing warning on mounting U.S. debt, and markets would be rattled if Treasury yields rise much further. So this is getting to a point where we're going to see some big action, I think, in the markets, in the economy. And we're finally starting to see some of these big investors, these people up in the top 10%, people and institutions, a lot of them are starting to get spooked at what is happening. I think many people expected the central bank to come in and cut rates again. I think ultimately that's going to happen. But right now they're in dollar protection mode, and they're in inflation fighting mode. They're losing the war on inflation, but they are in that mode where they're afraid to cut rates. Now we have the BRICS currency coming out, another slash, for lack of a better word, against the dollar. And it's going to be even more pressure on the central bank to keep rates elevated, because if you cut rates and you have this competing currency where more than half of the world's GDP and half the world's population are going to be trading within this currency coming out of the BRICS countries, you have some major pressure on the dollar. And that's why I've always said here, have some precious metals. We heard from our sponsor earlier, you can invest in precious metals now with your 401k if you have it just sitting there. So many things you could do. You could buy some each month, each week. With shipping costs, I try not to buy, really small amounts. I try to at least, get enough for 30 ounces or something like that. So you're not paying shipping on 3 to 4 ounces at a time, because those shipping costs can add up, unless you find a place with free shipping. But anyways, keep stacking, because folks, this is going to be payoff time very, very soon. I really think we're going to get to the point where 100 ounces of silver will buy you a house, because I think we're going to see prices correct in some areas. when money gets tied to something real, like what's being discussed here out of the BRICS nations. And I'm not saying that this announcement coming up later this month is going to be the announcement where it's going to be where their currency is going to be pegged to a weight of gold. Maybe, but even if it isn't, the fact that we're moving faster, and that could be enough to really spark the precious metals prices. And look at all the central banks that have been accumulating. Sorry about the sirens in the background. I'll wait for them to go by. Okay. The central banks have been accumulating precious metals. They've been beating down the price of silver on the paper market using futures contracts to keep the price suppressed. Why would they keep the price suppressed when they're buying the actual physical asset in the background? Because at some point, the price is going to be unleashed. The naked shorting is going to end. The real price is going to be revealed. To me, I mean, I think this is pretty obvious. Please let me know if I'm wrong. What do you think down below? Please let me know down in the comments. This is the way I see it. And, we've been pretty right about a lot of stuff here on this channel. We've been pretty on the point here. So please let me know what you think about the banks. Is this the worst nightmare with the sell-off happening with the balance sheet there at the central bank? And, what's going to happen next? Let me know what you think about the announcement coming up. Is it going to dethrone the dollar? We're going to see big pain in the dollar. So, and therefore, inflation is going to be so bad. Will it be bad to hold dollars even at a 6% yield, 8%, 10% yield, because inflation is going to take off because the dollar is under so much pressure? So interesting times here, folks. We don't have all the answers, but I'm just trying to encourage people to look at these things, think about these things, be ready for both situations: deflation, inflation, hyperinflation. I hope that's not the case, but we can't take anything off the table, folks. Pretty dangerous times here. I'm going to wrap this one up here. Thanks, everybody, for watching. Keep stacking. Bye for now. Peace.